Sounds good. Any questions from the previous session? We discussed about interest rates and securities valuation. We have seen actually the book says first know what are the determinants of interest rates, followed by interest rates and securities valuation. I flipped these two because we should know the relationship between interest rates and security valuation first, so that we can know more about interest rates. That's the idea. So regarding the smart book reading or assignments, if you have any questions, please email me. If you have a problem that would be related to Connect. Okay. If the grades are not seen, if it is showing not submitted or something like that, take a screenshot of that, explain that, and email me. I'll forward the same to Connect and talk to them. Okay. Interest rates. We have been talking about interest rates related to start with small investors like you and me, putting our money in bank deposits or certificate of deposits, or in short, CDs. That is what we know interest rate as. The other way, if you have taken any loan, the interest rate is charged on your home loan, car loan, education loan, even the credit card charges you with interest rates. This is what we know about interest rates. So the question to you is, early in the morning, to start with, do you feel interest rates are fixed or they will be changing? You take your loan, you take your CD, you take a bond, you take anything. Interest rates are fixed or they will be changing? What do you think?
They typically change over time, but when you take out a bond, it's usually fixed at whatever the interest rate is when you take it out.
It's a very good answer. You are very specific, differentiate. I appreciate. So when I deposited my money in Chase Bank last year, they offered me 3%. Now, when I'm depositing now, they're offering me 3.25%. It is CDs, yes, it changed. When I took loan maybe 5 years back, it was somewhere around 7%. If I plan to take it now, it is around 9%. There is a change. But as our friend was saying, when you look at investments on bonds, if you are investing, interest rate is fixed. But just take more on that. All the bonds do not offer you fixed coupon rate. Many of them may offer, but many bonds may also offer floating rate, which is fixed, changing rate over time. Whatever the market interest rate is there, when the time you get the interest or coupon payment, that will be applied. So my point of asking you that question is, interest rates are not stable everywhere in the world. And in US, it's more important because most of the economies follow US money markets, US debt markets. So interest rates, following interest rates in US is very, very important, very crucial. So I think you might have heard about rate cut, Fed rate meetings, and so on. Those meetings happen minimum 4 times in a year, and it could be more than that. Some people will be waiting. The Fed will be cutting down the interest rates, or someone will be expecting to increase the interest rates. Importantly, investors look for fixed investment securities. So in this context, understanding interest rates or changing interest rates, rather, why interest rates keep changing? Do they change every day? Like we see the stock prices. If you open Google Finance or Yahoo Finance or whatever, you see the stock prices changing every second. So do you feel interest rates do change that way? May not be. Let us see how the interest rate changes. Okay. So today what you have is we'll be learning about who supplies money. You call them as suppliers of loanable funds. Who demands money? The demanders of loanable funds, the borrowers. So these are the deficit groups. These are the supply groups. They have more money. They are the savers. These are the borrowers. Okay. So the trade-off between these two will make the markets into equilibrium, fall into equilibrium. If there is no equilibrium, interest rates keep on going up or keep on coming down or crashing down. So what will be the equilibrium interest rates? We'll see that. Then what are the factors causing the supply for loanable funds and demand for loanable funds increasing or decreasing? In economic sense, we call it as demand shift and supply shift. What factors cause that? How interest rates change over time? If there are no economic changes, but still you see there is interest rate difference between short term to long term. I think in the previous class we have seen that. Then coming back to the point of interest for the day, what are the specific factors which determine interest rates theoretically, empirically? Then what are those theories influencing or determining interest rates? There is something called a forward rate, which we dealt about last week. Futures, options, forward is also a kind of derivative. So forward prices are more driven by future interest rates. So we'll be covering that also. If you're looking at forward deals, how do you fix the interest rates as a forward rate? Then in the end, we also have some discussions, which will be some repetition for you, going back to compounding, discounting, annuities. Maybe you'll be looking at how EMIs and other things are calculated. So broadly, I categorized the discussions into these 5. We'll be talking about interest rates to start with. We'll talk about theories. Then the real discussion is this: what are the specific factors causing the demand or supply curves or both to shift? Then specifically, what are the determinants of interest rates? Then we look in the end about time value of money. I think when we are talking about rates of returns in the previous week, in the previous session rather, we are talking about what are the types of returns we discussed. Do you remember any one of you? Required rate of return, expected rate of return, and we also have seen real rate of return, if you remember. I was telling you, real rate of return is any return minus inflation rate. Okay. So any return which is given normally, that you call it as nominal rate of return. In interest rates, you call it as nominal interest rate. If you want to know a real interest rate, deduct inflation from your nominal interest. That gives you real interest rate. So usually the banks or the companies or the investors or fund managers, they all give you nominal returns. It is up to you who have to calculate a real return. So these returns affect the values of interest rates affect the values of most securities in money market as well as capital markets. In capital markets, in the previous session, we have discussed how interest rates change bond valuation, how interest rates change equity valuation. We didn't discuss about money market instruments. Okay, so money market instruments, they are also sensitive, but we will see that in the later slides today. Not only that, how the decisions will be changing in investors' point of view whenever interest rates change. Investors, not just investors, how business people change their investment decisions or funding decisions or borrowing decisions based on the interest rates. Even the governments, whether to issue more treasury bonds now or in future. It's all about present interest rates. Remember, don't feel that the federal or the central federal government has the power to change the interest rates and they just do it. No, it doesn't happen that way. We'll be getting introduced to that today and learning more in the next week. There is a system for that based on the demand and supply conditions. Things keep on changing. Some interesting trends we have. Just look at it. Just let me know what is that you got from this picture so that I can explain you later. Could you understand this chart? All of you have a look into it. And just let me know what could you apprehend from this.
Seems like interest rates spiked a little bit, but there's a recession.
Okay, so you're talking about this. Okay, good. Anyone else? Yeah.
I was gonna say, it looks like every time there's a recession, interest rates fall.
That's good observation. These are the blocks. The gray blocks are the recessionary times in US economy. Okay, that's what you two are pointing it out, right? Anything else? Okay, to start with, this is the data from 1972 till 21, almost 50 years, close to 50 years. This is the interest rates movement. I was asking you, interest rates are fixed or changing. Interest rates are changing actually. They're not so dynamic like S&P 500 or any stock market index, but this is the volatility of interest rates. The gray line is the federal funds rate. It is the rate charged by the Federal Reserve banks to the commercial banks or any other bank. That's one kind of a benchmark. And the other one is 3-month treasury bill. Treasury bills are issued by the Federal Reserve to the public. In the olden days, only institutional investors are allowed to invest in treasury bills. But post 2008 recession, I think anyone, including you and me, with as low as $100, you can buy a treasury bill. If you're interested, no broking account, nothing. Directly go to the, I forgot the website name, I will give you. You can go there and buy it. So 3-month treasury bill, if you remember, I was telling you, though some slides or books or authors say months or years, treasury bills are always in weeks. So take 3 months means 90 days. Take nearest weeks to that, you will find that because that is more active. That's the reason they have taken the benchmark. You could see that Fed fund rate is always above treasury bill rate. And till, I think almost to this point, till 2002, 2003, maybe till dot-com bubble. From there onwards, both are same. You can see that they're on the same line, red overlapping the gray. Okay. So these spikes, you could see spikes more in the recessionary tendencies. Okay. Apart from that, you have high interest rates in 1980s. US economy, 1980s was one era where it is a transition, a transformation of strategies to lend and borrow. That changed the picture. From there onwards, interest rates are low, very low. Okay. I think we have one more chart on this. You can say these are the interest rates for short-term interest rates. When you look at long-term interest rates, we have other benchmarks. What are they? We have 30-year fixed rate mortgage average. That's a red line. And you have a high investment rating rated bonds. Okay. So high investment rated means low risk. Have you heard about junk bonds? They are known as non-investment graded bonds where they have high interest rates, means high risk. So high rating means low risk, low return. So that is the benchmark here. So the same recessionary blocks you have here, we have seen here, the gray bars, we have the same here too. You can see that. So the maximum was in 80s. You can see here the spikes. Spikes are here. Later on, they followed the same trend almost. This is a little volatile from here to here, then again spikes here and here. But this is a little steady compared to short-term interest rates. It means that we can say that short-term interest rates are a little volatile or spiked compared to long-term interest rates. That's the moral of the story from these charts. Then getting into the theories. So theories does not mean that one author, one economist, he or she gave the personal view. No, it's not like that. So what is that? There has been a lot of research work in economics, importantly, where the liquidity preference theory, you might have learned that in macroeconomics sometime in your earliest terms if you have taken that. So based on those, there is something called loanable fund theory, where changes in interest rates impact security values. They confirm that. And financial institutions spend much time in effort to trying to. So because their interest rates are influencing the security values. So who are these financial institutions? Investments, investment banks, mutual funds, pension funds, commercial banks who are engaged in lending or borrowing and investing or accepting deposits. Okay, so these kind of companies, they look at identifying factors that determine the level of interest rates. So they try to forecast. Yes, there are some set of factors which will influence interest rates. You are in Jan 2026 and you're planning for, you got new funds this year. You're planning to invest your investors' funds on their behalf in the coming quarter. So what will happen to interest in the coming, in this quarter by March, say, for example. So that's what I'm trying to say here. They try to identify the factors determine level of interest rates at any moment in time. They're going to increase or come down, or they're the same. If that is the case, what exactly is causing the interest rates to move in this quarter, in the coming months or weeks? So that is one in financial institutions' point of view, where financial system is all about them. It is their decision to drive the economy, making interest rates to go up or come down or whatever. Then they also say, loanable funds theory also says that equilibrium is a result of supply of funds and demand for funds. So if you know the factors causing the interest rates to change, you should put them in supply side and demand side. Okay, not all the factors are influencing in one way. Say, for example, disposable income of the individuals in US has increased. That is one factor. Okay. The prices of the technology goods have come down. This is another factor. For example, if you take these two, they are contributing to, the first one is contributing to supply side. When disposable income of individuals in US is increasing, they save a lot. They put their money in the bank. They're ready to lend. Banks give more loans. So supply is increasing. That is the supply factor. When you look at a demand factor, the prices of the technological gadgets or whatever, laptops or smartphones or game stations or whatever, they have come down. That means there is an increased demand for these tech products. This is the supply side factor. So in this way, we need to identify the supply side factors and demand side factors causing supply to go up or come down, or demand to go up or come down. Okay. So interest rates will change. There are some factors and they contribute to change in supply or demand or both. I think there's no factor which is influencing both. Maybe we may have, let us see. So who are the market participants who are worried about interest rates? Consumers, common public, retail individuals, business houses. I think our point of discussion as a course FIN 4303 in your program, undergrad program, is more about businesses. When interest rates are going up, I'm the CFO of a company. I proposed my CEO that we need to borrow $10 million. $10 million. Now, my analyst in the company suggested that interests are going to come down in the month of March. Now, you tell me, should I go for borrowing in the month of Jan or wait till March? Obviously, wait till March, because my analyst told that interests are going to fall in the month of March. The other way, if he says, the analyst says, no dear, interest rates are going to shoot up in the month of March, then I better borrow now. That's what I mean by decisions of business houses. They take their funding decisions. When you talk about decisions related to interest rates, it's all about funding or financing or borrowing more than investments. Okay, because companies, they try to rely more on their internal funds accrued from profits. Okay, and they're encouraged to borrow when the cost of capital is low, interest rates are coming down. Even the federal governments, they also do borrow, and interest rates are low. Federal government offers long-term debt instruments, notes or bonds. Okay, and interest rates are very high. They always try to offer treasury bills for short term. Why? Because they also want to play the game. They don't want to be locked with paying higher interest rates for long term. So they're also worried about it. Then foreign participants, there are many countries, companies from many countries issuing bonds to American public. The reason is, in their country, interest rates are high. That's the reason they borrow here and take back money to their country and invest there. Same is the case with American companies. If they feel the interest rates are high in US, they go to some of the European economies and offer the bonds there for lower interest. There is an interest rate comparison advantage. Okay. Now let us talk only about supply side of loanable funds. So when you say suppliers, it does not mean that suppliers always supply, they also borrow. Okay. Investors are there. It does not mean they always lend or they always invest. They also borrow. Both happens. But at the net cash flow, it is positive or negative for demand side factor and supply side factor. That is important. So obviously this is a positive relation, as I was talking about a corporate decision to borrow in future if their interest rates are coming down, borrow now if interest rates are increasing, expected to increase in future. Similarly, lenders, banks love to give more loans if interest rates are going up, obviously, right? And similarly, if interest rates are falling down, they try to cut down the size of the loans, or they increase the paperwork. They make the rules tight, stringent, because they are lending at a very low rate. Then when you look at the household sector, which is termed as the largest supplier of loanable funds in the economy, these are the numbers a little old, but this is what we have from our resources. It is close to $85 trillion. Okay, in 2019, I think 6 years old data, but still it is something useful for us to understand. And look at the business sector has excess cash that it can invest for short periods of time, which is around 28 trillions for non-financial and 100 trillions for financial businesses. Okay, so usually whenever we have cash in hand, if you start most of your working, whenever you get the salary, you try to put your money in savings bank and to CDs. I had been using all the same because we all are small people to invest. But in corporations, whenever they have more cash or net high working capital or something like that, or positive working capital, they put their money in their current account, and they also move that to money market instruments or money market mutual funds, which is for short term, not for long term, unlike retail investors. And coming to governments, when I say governments, it's Federal Reserve government, state government, county governments at the counties level, cities, and so on. It includes everyone. Okay, mostly federal government. Governments will supply loanable funds, which is around 5.5 trillions in 2019. And you also have the net foreign investments, which is 27 trillions in 2019. So these are some numbers we had in supply side in US economy for loanable funds. And look at the demand side. Then, yeah, it is opposite. Loanable funds demanded is higher when interest rates will fall. I think this is something crazy. Borrowers wants to borrow when interest rates are low. Lenders wants to lend when interest rates are high. And when the lending and borrowing will happen? You got my point? You got my question? I'm saying that in the previous slide, I said that suppliers of loanable funds will increase the loans when the interest rates are high, but the borrowers demand loanable funds when the interest rates are low. Then how do the lending and borrowing will happen? That's where we talk about equilibrium. There will be a equilibrium in the market, equilibrium in the economy. Based on that, things will happen on a day-to-day basis, not quarterly or yearly. Okay. So when it comes to the demand side, I think purchase of homes, home loans has major stake in demand for loanable funds. followed by durable goods and the non-durable goods, accounting to 16 trillions in 2019. Then in business point of view, they invest in long terms. They never invest for short terms. They may, I think you might have read the balance sheets, short-term marketable securities in current assets, in your balance sheet. You see short-term marketable securities. You may also have that, but most of the companies, they do invest only for long term. Okay. And they maintain short-term working capital needs, as I'm mentioning, cash and short-term marketable securities. So they are put together 66.5 trillions for non-financial and 112 for financial. Non-financial means real assets, real goods. Financial means financial securities. It could be in negotiable CDs. It could be money market instruments. It could be equities. It could be any other security. It could be NBS or ABS. Government's borrowing is around 29 trillions in 2019. And foreign participants from business sector borrow in US financial markets is $21 trillion in 2019. So when you match this, supply side, it is 27 here, and it is 20 here. Governments, it is 28 here, and it's only 5.6 here supply side. It's very low in government's point of view. In business, financial 28, non-financial 98, lending side, but here it is 66 and 112. It is huge. Household, it is just 66, 16 here, but here it is 85 trillion. So now with these numbers, you can make out who dominates the supply side and demand side. That's the idea of showing these two slides to you all. It doesn't matter whether the data is from 2019 or 1970, it doesn't matter. Even if you get the latest data, you will have this kind of a distribution. Clear? The supply side and demand side factors influencing. We are not talking about interest rates. Who is demanding and who is supplying? This was the question I was saying when lenders wants to give more at higher interest rates and borrowers want to take more if at the lower interest rates. Okay, so there will be an equilibrium based on the interest rates prevailing and quantity of loanable funds. Maybe higher interest rates, suppliers are willing to lend more, but demanders are not interested. They will take less. When demand is high, when the interest rates are low, maybe supply is less, maybe they will give less number of loans. But still, the deals happen. Now, there is a condition in terms of supply and demand fixing an interest rate. So supply factors and demand factors fix an interest rate. Say, for example, home loan, it is home loan from commercial banks. On an average, it is around, say, 7%. I'm not sure, I didn't check it out. Now, that was in the last quarter, but this quarter, it has changed to 7.5. Okay. Now, what could be the reason? Whatever may be the reason, that you call it as demand and supply shift. Okay, because interest rates have changed. Why they have changed? Demand and supply conditions have changed. So with that, let us see more about this shifting factors. I'm sorry. Supply of loanable fund increase. In the previous slide, we have seen that interest rates goes up, supply also goes up. Not only that, when the wealth of the suppliers increase, their incomes are increasing. I give you an example. Disposable income of individuals are increasing. If that happens, supply also increases. Supply shift is there. Then in Other factor, the risk of financial security increases, the supply of loanable funds decreases. Higher the risk, lower the willingness to lend. Near-term spending needs increase, supply of loanable funds increases. We are talking about short-term supply and short-term demand. Then monetary policy objectives allow the economy to expand. That we'll discuss in the next week. What exactly the monetary policy? Yes, if it is encouraging, yeah, funds increase. If it is discouraging, less number of loans. People are not interested to borrow. Again, economic conditions, not just monetary policy. Your GDP is good. Exports have gone up. Tariffs have given a good result into the economy. That is pumping new investments from the government's point of view. If that kind of good news is there, again, the supply increases. If it is the other way, GDP is down, inflation is high kind of situations, no, demand is less. So put together, these are the factors, its impact, and change in interest rates. So interest rate, financial security is risk, short-term needs are direct influences on shift in demand and supply for loanable funds and shift in interest rates. They have the direct impact. Whereas the wealth of the lenders or surplus segments and monetary expansion and through monetary policy and economic factors, which are very much encouraging, they have an inverse relationship. So they're encouraging you, but it's up to you whether you go for a loan or not. They're discouraging you not to take a loan. It's up to you whether you want to take a loan or not. So we have direct and indirect factors influencing supply conditions and demand conditions, shifting the interest rates, upward or downward rather. And some more on this. When we talk about so some additional demand, when you look at these factors influencing, the interest rate is along the supply curve. Utility derived from asset purchased with borrowed funds, it shifts the demand curve directly. And the restrictiveness of non-price conditions shifts the demand like this. And economic conditions also shift the demand curve directly here. So other way of looking at what we discussed just now is if the utility derived, yeah, sorry. This one?
Yeah.
I didn't get you. This one? Yeah.
Yeah.
Restrictiveness of non-price conditions, when the shift in demand curve is happening, it is not usually when we talk about, I think, yeah, you might have seen law of demand, Marshall's law of demand. It's quite simple. For a given increase in the price, there is an expected quantity reduction. Of course, we have a given paradox, that's an exemption. But here we are talking about non-price conditions. When you have restrictiveness of non-price conditions, you are not allowed to buy some goods. Okay, price is the same, but you are discouraged to buy that because of policy through the state government or federal government or some other sources, whatever. That we will be discussing the policy discussions in the monetary policy, in the open market operations and so on. So what the point here is, it is non-price condition. Usually demand changes because of the price, right? Apart from given goods, exemptions. But here it says that Loanable fund theory says that apart from non-price conditions, demand increases or decreases because of the restrictiveness or encouraging conditions. Encouraging conditions increases, restrictiveness, it comes down. Yeah. So that is it about shift in demand and supply curves. And yeah, I think these are little more into utility discussions. As the utility derived from asset purchase with borrowed funds increases, I think the world is on this now. In the olden days means maybe 5 decades back, you are trying to you buy a new car, new home, okay? Anything that you like, if you have savings on your name, okay? If you buy that, there was more utility for the consumer. But since I think 80s, the scenario got changed. We started spending which is related to the future right now. We are advancing the spending. How? We are getting the loan, we're taking the loan. We are not having the money to buy a car, no problem. We get loan for that. Maybe in the transformation periods, taking a loan and buying was something negative, not accepted by the society, in not only in US, in many countries. But later on, it was a positive factor. It was a euphoria to have your own likely goods to buy, though you don't have the income or the savings on the name through loans. Why? Your utility is increasing. Earlier, utility was not that high by borrowing and buying something. But now we love to buy any electronic gadgets or car or new home or something. We love to see that. We are more happier than anything else. Okay. So that's what you mean by utility here. As the utility derived from an asset purchase with borrowed funds increase, demand for that loanable fund increases. Again, going back to the restrictiveness on non-price conditions, of course, decreases. And domestic economic conditions result in a period of growth. The demand for fund increases. And specifically into the fact that is about the loanable fund theories, which talks about behavioral things, economic theories, all put together, hitting the supply of the loans and demand for loans. Okay, but specifically, what causes interest rates to change? This is what we have the important list. Risk-free return. Any idea what is risk-free return? Any try? What is a risk-free return?
When there's no inflation.
When?
No inflation.
No inflation. So inflation rate is 0, for example, and you invest it somewhere. So any return you get is risk-free. I'm just giving you a case. Yeah. Okay, that's an example. I take it. That's an example. Yeah.
When the return you're supposed to get is pretty much certain.
Good.
That's what I was gonna say.
Same. So it's more about when you say risk-free return, we are talking about risk-free. It means zero risk, no risk. There's no risk. What do you mean by no risk? As we started the class today, as she was saying that when you invest in the bonds, the returns are promised, assured. It means there is no risk. That will be for 5 years or 10 years or 100 years. That is risk-free. Okay. So, but still, when you talk about a risk-free, the bonds issued by corporates or corporations, they are prone to credit default risk. You all know what happened with Enron. Such a big company defaulted. Okay, but governments will not default. Treasury itself is a counter guarantee for any kind of risk. So treasury bonds and notes for long term, treasury bills for short term are referred as risk-free instruments. Okay, so we'll be talking about this many times in the coming sessions. Make a note of it. So that is risk-free. I think we already talked about inflation. So higher the inflation, higher the interest rates. Okay. Then default risk. Just now I was talking about Enron, which defaulted its borrowers, its depositors, sorry. Then liquidity risk. Liquidity risk. What do you mean by liquidity risk? Yeah. Okay. Got it. Yeah, you have something? You're saying that?
Oh, no, I was gonna say.
Okay.
There's not a lot of supply and demand.
It's coming in.
There's not a lot of supply and demand for it.
Yeah, I think, yeah, you are reinterpreting what you said. You're right. Yeah. Anyone else? Liquidity risk. Yeah.
When it takes longer to liquidate, so like a house or something, you can't really like
You
sell.
added one more point. That's good. That's good. So you invested in an, I'm not talking about what kind of asset it is. You invested somewhere, but when you wanted to liquidate it, when you want to sell it, when you want to make money out of it, its price has gone up. Value is good, but you are not able to realize the value. You're not able to sell it. Maybe there is no demand, there is no supply, there is no market. That you called as liquidity risk. There are many stocks. There are some investors which I know. I had one of my friends. He always picks up the stocks which have huge liquidity risk. Because of that, price is low. He tries to buy on those things. Okay. So maybe there is no liquidity or less liquidity. These two are again different. When there is no liquidity, I think it's a worse condition you are experiencing. Little liquidity, at least better. Then special provisions for covenants. So it happens more with debt instruments, bond covenants. They say that there will be some restrictions for the issuers while issuing the debts, that they will not further issue more bonds in future. They will not sell any assets. There will be kind of covenants which are written while issuing the bonds. Okay, so that kind of things also have a impact on interest rates. Then term to maturity. Longer the maturity, lower the interest rates. Shorter the maturity, high is the interest rate. Agree? Actually, I'm wrong. I'm sorry for that. Longer the maturity, higher the interest rates. Shorter the maturity, lower the interest rates. So when the timeline is up, why high interest rates for long term? Because huge risk. You never know. You are looking at a bond for 3 years and 30 years. 30 years in a company, you never know. Instead of that, maybe there are known investors. I've been referring to investors because I was also active investments in equity. I was also a stockbroker. I got a variety of investors and traders around me. So what that guy used to do is, he used to pick up short-term bonds, say for example 3 years. 3 years, invest, redeem it, again invest for 3 years. He never used to pick up bonds or debt instruments for 10 years or 20 years like that. That was his strategy. So these are the specific factors which are universal, influencing interest rates over a period of time. Okay. So whenever the US government is worried, whenever the inflation rates are up, not only US government, any government, policymakers, they step into the meetings and say that what should we do? Inflation is up. I'm not talking about inflation rates which are abnormal, unusual in many countries, some of the countries, not many countries, but many countries, they do monitor the inflation rates. Higher the inflation rate, Fed rates are aimed to go up, expected to go up. Some interesting, whenever we talk about yields, we are referring to interest rates. Yields, I think in the later part of our course, we'll be talking about debt markets. We'll be talking more about them. But quickly about them, yields means they refer the interest rates. Yield curves gives you the direction of the interest rates. They're falling or flat or increasing or bumpy and so on. So this one, the first one, it is almost a flat yield curve showing there is no change in the interest rates for 1 month to 30 months. Okay, 2.5 years. These are the real numbers. They are not hypothesized estimates. The real numbers of US bonds, US Treasury bonds. So here yields for short-term and long-term maturities are approximately the same around. So why I'm saying short-term and long-term? Up till here, it is short-term. From here onward, it's too flat, long-term. Rising yield curves, I think long-term are steeper, short-term are flat. Okay. So this was observed in October 2014. Okay. This is the rising yield curve. This is a flat yield curve. And this is a falling or inverted yield curve. So what do you mean by this? I think in short term, it is very aggressive, volatile. In medium term, like treasury notes, yeah, it is volatile and falling. But treasury bonds, maybe long term, 11 years to 30 years, it is almost flat. But it is inverted here. You can see that. And humped yield curve, it is rapidly increasing in the short term, flat for some time, coming down, increasing, coming down, and flatter. This you call it as a kind of hump-shaped or humpy yield curve. These are the broad categories of yield curves that you may see. We'll be seeing that actually when we look at the charts in the debt markets. Then the relationship between a bond's interest rate and its remaining tenure also has the influence on the interest rates or the yields. So this is explained by these three theories: unbiased expectations theory, liquidity premium theory. We'll be talking about the forward premiums, which I was talking about here. So there's nothing to remember or mug up or work on the problem. Just understand this. What does this tell you? So unbiased expectations theory, what it says is, at any given point or at a given point in time, the yield curves that which we have seen, it gives the market's current expectations of future short-term rates. Okay. So based on the expectations or the probabilities for the future change in interest rates, like I was always telling you, we are in the first quarter, we are in the month of Jan. I'm expecting the interest rates to go up or come down in the month of March. Like me, the market participants also expect the forward changes in interest rates for a short period of time, a month or few months, not quarters or years. So how it is arrived is, so today's rate or interest rate is a combination or factor of today's interest rate times the expected interest rate. Remember, this is for short term, not for it is not for several years. Even actually I mentioned it as years here. It may not be years also. It will be for months, 1 month, 2 months, 3 months. Okay, because this is the theory which is the base for forward rate calculations and derivatives. Okay, is this clear? Unbiased expectations theory? It's very simple. We are expecting future interest rates based on today's interest rate. We are trying to arrive at a forward rate. How do we do that? Today's at 1 plus today's rate times 1 plus expected rate. Okay. If you have different rates for example, the whole thing is for 10 years, for example. This is for first year, then add on for second year till 10th year. For example, this is for 12 months, 1 year. In that case, what is the monthly rate for this month? Then monthly rate for next month, so on up to 12 months. You add on. That will give you this. That's how you arrive at. Again, you can ask me or question me, how do you get the, in textbooks or exams, it is given to you, it's very easy, right? But in reality, how this is expected. They themselves have a lot of models based on the historical data. Historical, I think technical charts, technical analysis will help a lot on this to arrive at moving averages or averages. There are many, let's not get into it. Okay, that you will learn more in investment analysis. Okay, if you're clear with that, the next one is liquidity premium. This more talks about risk neutral investors. Risk neutral means I don't care. I don't assess risk. I don't want to talk about risk. I just want return. I'm looking at return. They forget the idea that higher the risk, higher the return, lower the risk, lower the return. That you call them as risk neutral. So hitting that liquidity premium theory, what it says is this. So today's or future return is the outcome of return for today's period and expected return for the next period 2, period 3, period till n. Plus he adds something called as L. What is this L? Liquidity premium for a period T. So liquidity premium means if I'm talking about a 10-year bond, for 1-year bond, I want very less premium, less or little risk premium. For second year, I want more. Third year, I want more. So when the tenure progresses, the L value increases. So he clearly differentiate a short-term bond, medium-term bond, and a long-term bond. That's the beauty of liquidity premium theory. And this is more important if your bond is locked. You can't trade. You just get the coupons. Okay, this is more important for that kind of investments. Then last theory in this is market segmentation. So what they say is they have specific maturity preferences. Maturity preferences, retail individuals may just invest and forget about it. But institutional investors, they keep on watching the market trends, demand supply conditions, forecast them, and accordingly switching their investments, debt to equity, equity to debt, or stay in cash. There's a big thing going to happen in the economy. Let's wait and watch. They make a lot of segmentations. Okay. So financial institutions, they do, it's not for themselves. If you take a mutual fund, they clearly state this is an aggressive growth fund. They say that. It means accordingly, they will build that kind of a portfolio. Okay. And with some other fund says assured returns fund. It means they are very cautious. They look only for returns more than wealth or capital gains. Okay. So that way, this talks about segmentation, where investors have different maturity preferences, substituting their investment goals or objectives. So based on the horizons, investors are segmented or investments are segmented. So expectations theory, liquidity theory, market theory. These three are notable or important theories related to interest rate determination. I think this is a little older, unbiased expectation theory, but liquidity premium and market segmentation is more applicable in today's world. It's all applicable. Again, I got some more charts for you quickly on this. So what I have is demand and supply for short-term funds, demand and supply for long-term funds, and finally, yield curves. We'll be looking into these three. The first one is demand and supply for short-term securities. Can any one of you help me? What's the difference between these two? By the way, on x-axis, you have quantity of short-term securities lended or supplied or demanded. Here you have the rate of interest, the supply side, supply rate. They both are for short term, both are the same, but it shows something different. The picture is not the same. Can you figure it out, or can you help me to differentiate these two? Anyone? You can try anything. There's nothing wrong. I'm not assessing you. Yeah.
The bottom one is a low supply.
Okay.
Yeah, I was just gonna say that the lower one.
Yeah. So x-axis is meant for quantity. So I'm clearly showing you this is the line where the quantity is supplied, right? And this is the quantity, this is the demand line at this rate. Okay. This is the supply. I don't have anything to write on the monitor. This is a lending borrowing rate. At this lending and borrowing rate, this is the demand line and this is the supply line. Yeah.
It's just like macro and micro, right? I'm getting it.
Exactly. Yeah. Perfect. We just borrowed. We're not doing anything new. We just borrowed them. Right? So this is the equilibrium. Okay. So this is the equilibrium curve where if interest rate is here, the demand will be here. If interest rate will be here, the demand will be here. This is the equilibrium. That's what it means. The curve is the same here and here, but shift in the curve or change in the supply and demand quantity I'm representing. Okay. So here you can see that the supply was, say, this is 100 loans. Okay. It has come down to maybe 25 loans here. You see the difference? This is the supply, assuming this is 100 and this has come down to 20. What's the reason it has come down? From here to here. It moved to left from here to here. Yeah.
And increases, say increase.
But because demand and supply are acting individually here. Okay. So you can see that here, say the rate of interest is, say, some 7%. Okay. And it has come down to, say, some 3%. So obviously this stepped back. It shifted to left. Low demand. We are not talking about demand point of view, supply point of view. Because the interest rates have come down, supply has shrunk. That's the idea here. Is it clear? Remember, we are talking about short term. This is a short term curve. If this is understood, yeah, you have a better picture. I think now you can understand this better than the previous one. Can any one of you differentiate or talk about these two? What's happening? Yeah.
I'd say it's almost the same, except
Yeah,
there's just
that's it.
more yield.
As simple as that. It's the same. So here, I think I borrowed the same lines which we used for short term. This is for short term, here and here. And for long term, this is the line and this is the line. Okay. The quantity supplied increased because the loanable rate has increased compared to this. The loanable rate is here, say some 7% here, it is some 10% here. Okay, so that's the difference. So what we understand from this is whether it is short term or long term. If interest rates are low, supply will come down. If interest rates are high, loanable funds will increase. And we have seen the factors for that. Okay. Is it clear? Any question on this and previous? Okay. Now, finally, the yield curves, the kind of yield curves we have increased, it is the same. I think this is not a new thing. When we say this is a yield curve and what I'm showing there is also a yield curve. Just for simplicity and understanding, it was just a straight line. No yield curve is so straight like this, right? For understanding, I'll just put it like that. So these are the two yield curves for us. This is steeper and this is not steep. Okay. So they provide, this is related to time till maturity. Usually the normal yield curve looks like this, and this is a steeper one. So why the curves are, the curve is steeper means the market has become very sensitive. We talked about duration, if you remember in the previous session. If the duration is high, sensitivity is high. Sensitivity is for longer period. So that makes the yield curves spiked or steeper. Okay, that's how they look like. Okay. Any question from this? Is it clear, all of you? Then the last part for the day. I think I'll just show you. I not work on this, but I'm showing you this because these concepts are important for the coming sessions. That's the idea. So, you know how to value a single cash flow or lump sum, how to value multiple cash flows. I think in the previous session also we did dividend discounting for multiple cash flows. We are using the same here. Quickly recharging you with the formulas, old formulas. We have been learning this for many years, I believe. Not in your undergraduation, in school also these things are taught to you. This is the formula for discounting or present value. This is the formula for compounding or future value. I think the same thing I put it here. There's nothing difference here. Now, this is a present value or annuity valuation. When you have series of like cash flows, you have dividend discount models. You have the same dividend for 10 years. How do you discount that? This is what you have. Present value of annuity. Then capital recover factory. This is a kind of EMI. How to arrive at an EMI? You're supposed to pay, say, 50,000 for your car loan. 50,000 is the loan value. How do you do it? This is the formula. Okay, you will get the monthly EMI. I put it as A or annuity here. This is what you have to pay monthly to your bank. You can calculate for yourself. Sorry for that overlap. I give an example here. You can cross-check that. Yeah, this is the formula. Done. Oh. Perfect. This is the example you have. If a person buys a $3 million worth house, home loan, and what is the EMI? I put the values here. with an interest rate of 12%, this is too high. And this is not practical. This is an old example. EMI is 71,178, so on. So what happens in your EMI in the initial months? Okay, your principal payment is this, and there is more of interest recovered in the initial installments. In the last installments, less of interest payments and more of principal payments. I'm just showing you. Sinking fund, some companies, when they borrow or they want to borrow for future, they accommodate some amount so that they can accumulate. As I was telling you, taking a loan is easy now. But in the olden days, 60s, 70s, 80s, people used to accumulate the savings and plan for a buying something, which is very costly. So for them, the sinking fund factor is very helpful. So they will arrive at, I want $1 million after 10 years. How much monthly I need to save? This formula will help you. This is a kind of compounding factor. 100,000 for future, 10%. Yeah, you have to save 16,380 per month. And one more thing, period of compounding. I think all the banks in US, they offer you quarterly compounding. I was told by one of my students that one credit union is offering monthly compounding. Even the same is the monthly CD rate. When the frequency of compounding is high, you're at very rich advantage. Look for those investments. Okay, so yearly compounding, no bank offers. I feel most of the banks offer quarterly. I'm not into CDs. That's the reason I'm not aware of it. Quarterly compounding. You may also have more. You may have continuous compounding also. So obviously value increases as M increases. I had an example, I believe, here. So this is you might be hearing about this effective rate of return. When frequency of compounding is more than 1, you should calculate effective rate of return. Okay, then you arrive at what exactly you are getting. So if M is 1, expected rate of return and effective rate of return and nominal rate, they are the same. But M is greater than 1, effective rate of return is definitely greater than nominal rate of return. So continuous compounding will give you more. I just gave you an example. With the same interest rate per year, it is once in a year, 110,000. But if it is continuous compounding, 110,517. You get the maximum benefit here. So that's it. Any questions from this? Yeah. It's already there.
Okay, so we'll like.
Yeah, whatever we are using here, I think this is why I showed you these things is I want you to wake you up so that you'll be alert for the coming problems. Even my own slides have those problems. You can use them, but I'm suggesting you use Excel. Excel has everything. You need not write the formulas and do the calculations. Okay. Thank you. All the best. See you in the next week. Any latecomers? Let me know. Give me a minute.